All right, so when you talk about load funds, how many people have purchased a load fund before? Nobody wants to admit it? Yeah. Okay, all right, there we go. This is a great person. Okay.
I think I'm very sensitive.
Okay, especially after that discussion, you don't want to admit it, right? Okay, so the traditional load fund charged an upfront commission, right? Those are called Class A. Let's just put over here. A, okay? So I'm going to talk about the biggest mutual fund in the world right now. Okay, it's just as a live example, which is PIMCO Total Return. Okay? PIMCO is headquartered right over here in Newport Beach. Over here? Which one? Okay. They're the largest mutual fund in existence today, $250 billion under management in this one fund. Okay? Now, institutional money managers, people that manage large sums of money, have access to this fund. If you invest with one of these institutional money managers, like a pension or something like that, the expense ratio on that fund is 0.46%. I'm just going to call this, we're going to get back to the A load funds. I'm just digressing for a minute here. Institutional fund, okay? So the expense ratio on PIMCO Total Return, if you invest in an institutional format through a pension or something like that, there's an expense ratio of 0.46%. PIMCO Total Return, the same fund is also sold by brokers. Class A has an expense ratio of 0.9%. Okay? Almost double. In addition to that, for the privilege of investing in the Class A, you will also pay an upfront load of 3.5%. Okay? Same fund, same exact fund. What's the load here on the institutional one? No load. Okay? Institutional managers don't pay loads and their clients don't. Okay. There's also other types of load funds. Sometimes these aren't called load funds because they don't look like load funds. Those are Class B and Class C. The load on a B and the load on a C, the front end load, let me clarify, 0. The expense ratio on Class B and Class C, 1.65%. Same fund. Okay? So if this fund earns, let's say it earns 7% gross. The institutional fund, how much did that earn? About 6.5, right? 6.54. The Class A version earned 6.1, right? I'm just doing basic math here. 7 minus the expense ratio. The Class Bs and Cs earned 5.35%. Everybody follow? Okay, same fund. Okay. Now, PIMCO's a good fund. PIMCO's a great fund. Just think if they're selling you something that's not a good fund. Okay? And I'm not saying, I just picked a random number here, but I mean, PIMCO happens to be a good fund, but you can still overpay for something good. But a lot of people are buying bad funds. Okay? Stock funds, you might pay a front-end load. The typical front-end load on a stock mutual fund is 5.75%.
That's the money you would pay up front?
Correct. Yeah, so if you invest $100 and they take 5.75% off the top, then you have $94.25 working for you. Now, Peter wants me to emphasize the following. I hate to say this, just because I don't like to say this, but it's true. Many of the people selling these products A, B, C. They're not sophisticated financial investment advisors. They're salespeople, okay? You're not dealing with someone that's analyzing markets. You're dealing with people that are out there selling. Maybe a couple years ago they were selling cars, now they're selling Class A, okay? Okay, by the way, I want to mention this happens at the very highest level, okay? It's not only naive, small investors that are taken advantage of. And I was thinking about this last night and I was saying, I'll bet when I wake up this morning I'll be able to find something in the newspaper. Well, right on the front page of this morning's Wall Street Journal, okay, this is from this morning. Let me just read a couple paragraphs that I highlighted. The title of the story on the front page is Banks Near Deal with the SEC. Here's the key paragraphs. SEC securities regulators are in talks with several major Wall Street banks to settle fraud allegations related to mortgage bond deals that helped unleash the financial crisis. The cases highlight aggressive tactics banks used to sell these securities to investors who suffered big losses. One more part. Goldman Sachs, by the way, Goldman Sachs deals with very wealthy investors. Very, very wealthy investors. $550 million penalty that Goldman Sachs paid last year to settle allegations that it misled investors in mortgage bond investments. Goldman didn't admit or deny the allegations. It always ends like that. They don't admit or deny the allegations.
They just pay the fine.
Right, exactly. Okay. By the way, there are also, these are all no-load funds. I mean, these are all load funds, sorry. Okay? No-load funds, you can buy directly from the fund company, typically. Now, that happens to not be the case with PIMCO, but many, many funds you can buy directly from the fund company as a no-load fund. Vanguard is the most well-known, but there's many, many fund companies that you can buy directly from the fund. And if at the end here, if we have time, I'll just give you a few names, just in case you want to do some of this on your own. I'll give you 2 or 3 names that I've used in the past, where you can go directly to the fund company, invest, no load, no charges, and you get a quality fund with quality management. Okay, let me move into, by the way, no-load funds can also be purchased through discount brokers. So if you wanted to use several different companies, you could open up an account at Schwab or Fidelity or TD Ameritrade, and you could buy them. You might end up paying some transaction charges in that situation, but that's another way that you can buy no-load funds, okay? All right, let me talk about a few things that you want to look at when you're buying funds. Okay, so inflation is a tricky situation right now, right? There's different ways to hedge against inflation. And by the way, I'm happy to take questions here, not only on mutual funds, but general investments or economy type questions as well. You could hedge, there's formal instruments that can hedge against inflation, funds that sort of tied to the CPI, the Consumer Price Index. Those are called TIPS, Treasury Inflation Protected Securities. Treasury Inflation Protected Securities. Vanguard has a fund that invests in TIPS, so you don't have to go out and buy these individually. You could invest in Vanguard. One of the concerns, what's maybe one of the concerns with the Consumer Price Index, though?
Doesn't reflect reality.
Yeah, that's exactly right. That's exactly right, right? I mean, there was a recent, one of the Fed governors was at a luncheon and he was explaining how the CPI is only 1%, because even though, some of you may have heard this, even though gas and food are going up 10%, you know, iPads were going down, and somebody from the audience said, well, I can't eat an iPad, so, you know, I mean, what good is that? So yeah, so that's one of the risks with TIPS, is that if the CPI doesn't accurately reflect inflation, then you're only going to get a certain amount of inflation protection. So other ways to do it, it's much trickier though, is to invest with commodity funds. Okay, that gets much trickier. I think the easiest way, one easy way, it's expensive now, but it still may be a way to at least consider is something like gold or something like that. Okay, and we can talk more about that at the end if you want. The first thing with mutual funds is that you have to know, which sort of separates the universe of funds into two broad categories. Is it an active fund or is it a passive fund? What's a passive fund? What's another word for a passive fund? Yeah, exactly. It's an index fund, right? So the most well-known index, stock index, for example, is either the Dow Jones or the S&P 500, right? Well, let's just put the S&P 500 down here. So you could have a fund that just replicates the S&P 500. They don't have to make any decisions about buying or selling. They just replicate the index. Or you could have an active fund where they try to buy and sell different stocks, and they're trying to do better than the S&P 500. Now, why might be a couple reasons why you want to just have an index fund or a passive fund?
They make more money over the long haul.
Well, that's true. Actually, on average, they're going to outperform the average money manager. Most mutual funds, historically, will not perform as well as a basic index. So they're just out there, they're generating all kinds of trading and making money, but they're not doing anything, they're not adding any value. Okay? So for most investors, you're better off just being in a passive index. What's another advantage of an index fund? If they don't need to be researching stocks, what does that mean?
Low fees.
Yeah, less expenses, right? They don't have to hire research analysts and all that kind of stuff, so you can have fraction of the cost. So one of the things is, when you're looking at an expense ratio, which I mentioned earlier, you've got to remember that on a passive fund or an index fund, that ratio should be much lower than on an active fund. So I checked this morning to see on Vanguard 500, which replicates the S&P 500, your expense ratio is going to be 0.18%. Okay? That's a good expense ratio for an index fund. Now, you can't find this on an active fund. If you're looking at active funds, you can't find an expense ratio for 0.18. But, if you have a stock mutual fund on an active basis and you get below 1%, that's good. Okay, today most of them are higher than 1%. So when you look at expense ratios, it depends what kind of fund. In general, obviously active is going to be more expensive than passive. Stocks are going to be more expensive than bonds. There's a newer kind of, it's not that new anymore, but it's relatively new, a new kind of index fund, a newer kind of index fund which has become very popular, and that's exchange-traded funds, otherwise known as ETFs. Okay? An ETF, generally speaking, is an index fund that trades throughout the day. So you can buy and sell it just like a stock. Okay? But you can't go directly to the company like you can with a Vanguard. And so generally what you want to see, if a fund's getting larger, you'd like to see the expense ratio going down. Okay? Because, there's economies of scale, and once a fund reaches a certain level, if they continue to grow, they should pass on those savings to investors. If they're not lowering the expense ratio as they grow, then that might be a sign that they're not shareholder oriented. Okay, so I would expect it to go up, but it should either stay flat or go down.
But the fluctuate at will is not guaranteed for a year or fixed for a year?
No, it's basically structured. The management agreement with the company is usually written in a way that the manager is paid X percent on this level of assets and this percent on that level, and then it's sort of on a tiered structure. So it's going to depend on how many assets are in the fund.